Now, I'm not big on the intricacies of each individual chart pattern because all I really want to see is where the imbalance lies. And the guide that I put together for trading certain price patterns, it's free, and you can download it at the link up here on the right or in the description below. And I don't cover this cup and handle chart pattern in that guide, but there are parts of this pattern that I do like. First, you have to remember that it can be a continuation pattern, or it can actually mark the turn in trend from a downtrend to an uptrending market. So that would make it a reversal pattern. So why do we call it cup and handle? Well, price forms a U-shaped pattern, and it resembles the rounding bottom of a cup, or a bowl, really. And this is subjective. Price makes the high, a pullback occurs, and then it begins to move upwards, and that forms the handle of the cup. Now, virtually every single chart pattern you're going to look at, it's subjective, so you don't have to look for exacts. And if it doesn't stand out to you, it doesn't pop out at your eye, then it's probably not a pattern that's even there. Now, chart patterns like this one here, it's a form of technical analysis, and it actually can give you indications on where you can enter the trade, where your stop should go, and even where to take profit. And I'm going to cover how to trade the cup and handle pattern, and then I'm going to outline the 6 simple steps at the end of the video. But first, we have to recognize it. Now, this pattern is not time dependent, and there could be an edge in using them on higher time frame charts. So we can find the cup and handle at 2 locations. If the market's in a downtrend, we look for price to make a rounding transition and start to move upwards. And since this is a bullish pattern, if the market's in an uptrend, we just look for a move down in price. This here is a daily stock chart, but cup and handles can be found in any single instrument, any time frame, doesn't matter. Price is in an overall uptrend, price is pulled back after a gap up, and strong momentum in the stock. So as price forms that rounded bottom, the overbought condition of the move that went up, it's worked off, and price begins to move up, and the cup and handle formation begins. So as price moves lower and then higher again, it forms the sides of the cup, and eventually it meets up with the previous pivot high that forms potential resistance. Now, when and if price stalls at this level, we call it the peak of the cup, and now we want to see the handle form. Now, the handle of the cup, as seen on the right side here, can also be considered a bull flag, and traders can trade that pattern. What we don't want to see is the handle pulling back too deep into the distance of the right side of the cup. So if price was to pull back over 33% of the height of the sides of the cup, we would probably want to avoid this as a cup and handle, because we want to see sustained strength or lack of weakness as price sits at the peak of the cup. If price falls too deep, it's probably going to demoralize the buyers, and the edge in the pattern is going to be gone. So essentially, we want strength into the cup and handle pattern, breakout, and deep pullbacks can negate that. So the cup forms as price hits up against resistance, and the handle forms as price pulls back from that level. So now what do? Well, now we need a place to enter the market, and we have rules that we can now use to enable us to take advantage of this pattern. There's an aggressive entry, and there's a more conservative entry that we can use. The aggressive entry is going to front run the completion of the pattern, so you have to be aware of the risks that are involved in doing that. And we can use any entry technique that would be the same as trading any pullback pattern. And for this example, we're going to use the same chart as we already have looked at. And if you want to check out my video on trading pullbacks, the video is linked up here on the right. Now, using an upper trend line and mirroring on the bottom of price, we can capture the rhythm of the pullback. It's a channel. It can also give us an early entry as price breaches the low of the channel and is bought back up. And this is kind of a form of a failure test trade, but we're using it as an entry technique into a pullback that forms a handle of the cup and handle price pattern. Waiting for a breakout of the handle, that's going to complete the chart pattern, and that would make it a conservative entry. So what you need to do with that is to decide what a valid breakout is for you. Do you need confirmation of volume? And if you do, are you going to trade the spot Forex market with this? Do you need to see a strong candlestick close? Will you just buy stop the upper channel and just let the odds play out? Now, this chart shows a less than perfect cup and handle formation, but you got to know that at times you're going to have to use some discretion. The conservative entry would take place on the close of the candlestick that breaks the upper channel. So keep in mind that price did dip deeper into this pattern, but you can see price rejection. So ask yourself, would you still take the trade even though it pulled back this far? So that pattern has failed after the breakout, and while some would expand the channel lines thinking that a complex pullback is forming, price has now already hit too low in the pattern. So setting the stop loss is pretty simple on this pattern as well. In both the conservative and aggressive entry, I would use below the low of the pattern with a little bit of wiggle room. And some traders may decide to use the average true range to read volatility and use that for their stop loss. But regardless of the placement, ensure that your stops are taken without question if price reaches them. And also, I don't want you to get caught up in that lower risk trade mentality, because there's no such thing as a low risk trade if you're using a percentage of your account to determine your loss size. That will then translate to the number of shares, the contracts, or lot sizes that you can buy. So if your stop loss is hitting below the halfway point of the price pattern, you may decide just to scratch the trade because your take profit levels may be too far away from the entry price. All right, so let's cover that. Common wisdom with these patterns is you take the depth of the cup portion of the pattern and project that from your entry. There are a few issues that we have to address when it comes to price targets and trade management. Our ultimate price target is the measuring of the distance from the bottom of the cup to the top projected from our entry area. So in this example, the entry is at the break of high of the candle that tested the lows and was rejected. Our stop location is going to be 2 times the ATR, and we're going to round that to $10. Our ultimate price target is the depth of the cup projected from entry, which would be an increase of $66 per share for a 5-to-1 reward to risk ratio. We have an issue just above our entry called potential resistance. So this pattern is going to fail. The opportunity is either at the handle formation or at resistance. This is no different than the standard pullback trade. And here we are looking to profit from a breakout of resistance, the peak of the cup. So from a trade management perspective, I would consider taking partial profits at the potential resistance level. And I say potential because we don't know if it's actually going to act as resistance, but that level where price could fail or at least be on alert for the failure of price. However, before price broke from the upper channel of the handle, price has already moved 1R, 1 times your risk. So scaling out and banking some profit, and that would reduce your overall risk percentage, is a smart play. So this way, if price does fail at resistance, we will still take some profit and probably scratch on the other position. That is the advantage of taking the early entry. For the breakout of the handle, I need price to break resistance before hitting 1R. So you need to define how you're going to enter these trades. That's really important. So let's cover something that you have to consider, what the cup and handle pattern is in reality. And quite simply, we are trading a pullback in an uptrend, and we're banking on a breakout trade. The pullback will give us an early entry into the breakout of resistance, so keep that in mind. You want to look for a market that's reversing in a saucer-like formation, and it can be from a downtrend transitioning to an uptrend or an uptrend already in play. Price forms the right side of the cup as price travels to resistance. You want to look for some type of consolidation of price. Pullbacks and ranges, they're pretty easy to spot. Enter either during the pullback or when price completes the handle part of the pattern. Project profit targets from the depth of the cup from entry. Manage trades, paying attention to the resistance that formed as the cup completed. And I don't get caught up, as mentioned, in the different chart patterns because, as you can see, the cup and handle pattern is just other patterns combined. So I hope you liked the video. And if you did, hit the subscribe button, hit the like button, and I appreciate you watching. Any questions, pop them below, and I'll get to them. Thanks.